So next I'm introducing Matthew Weatherley-White, who is hosting a conversation about aligning our investments for impact. And Matthew is actually Boise-based Caprock Group. Caprock is a global investment advisory firm with a passion for impact. Matthew leads that effort there. He calls it not just impact investing, this is better investing. And so he's got a fantastic group of folks he's going to host here on stage. Please join me in welcoming Matthew Weatherley-White to the stage.
Presumably, I'm supposed to have some prepared remarks for this moment, and I don't because we have a short amount of time and we have some awesome, badass investors with me. So rather than having me suck up any more than 3 seconds, I'm going to invite them all to join me here, self-introduce, and then we're going to get right into the meat of the conversation. So we're stoked to be here. Come on, you guys. So as I said, 3 awesome panelists here. They're all asset managers. They're all doing tip-of-the-spear, cool, innovative work in the public equity and private equity sectors of the market. But I do want to take a second to frame this conversation. So you've heard in the last several panels, first, a fairly abstract overview of absorptive capacity in the impact investing world, how you can move your money, thinking about where your cash is sleeping, thinking about knowing what you own. We then heard from Tom giving some really interesting sort of on-the-ground, seed-level investments using really high degrees of technological innovation to solve some of these problems, but at a pretty early stage. These guys invest for later stage investments, both in the public markets and in later stage private equity markets. So to sort of stitch that narrative together, think about $1 moving from abstract, hey, I really want to do some impact investing, my money should be more aligned with my values, I'd like to have some cool things that I can track, to slightly more concrete, on the ground, really, really early stage stuff, high risk, but super potential for moonshot results, to growing companies that are scaling and in place and profitable. And that's where we are right now in this conversation. So what I'm gonna do is I'm gonna ask my fellow panelists to take a few seconds each, 30 seconds, a minute maybe, to introduce themselves and their firms, and then we'll dive into the conversation. And I would love, Kristen, if you could please start. Full disclosure, these guys are all friends, so we're gonna have fun.
It's great to be on stage with all of you. And just to recognize, it is a beautiful day outside, and you guys are in here with us. So thank you for being part of the solution, for taking this all in. We recognize that it's a fire hose of information, and we are thrilled that you are here today with us. I'm Kristen. Some of you, I talked to you yesterday. I run NIA Impact Capital, and NIA means intention and purpose. And so we are really helping people just move their money out of the problems and into the solutions. And as Matthew has mentioned, both on this stage and other stages, this really is just smart investing. It's investing into the future that we want. And so that's what we're going to talk about today.
Colin?
Hi, my name's Colin Leduc. I'm one of the founding partners at a company called Generation Investment Management. We were founded 15 years ago now to really try and prove the investing case for sustainability and to advocate for sustainable capitalism. We manage about $23 billion today and invest that in both public and private equity markets. The 2 really famous founders are Al Gore and a guy called David Blood, who used to run asset management at Goldman's. And so some people know us as the Blood and Gore Fund because of the 2 of them. We actually debated calling ourselves that. I kid you not, but we thought for an asset manager it's probably not a great name. Probably a better name for an English marmalade or something. But anyway, but I mentioned them because we basically feel that you need to put the highly sophisticated finance together with highly sophisticated sustainability understanding. And Gore obviously epitomizes, a very, very deep understanding of sustainability, and Blood epitomizes a deep understanding of capital markets. And we see a mismatch in a lot of investors today who claim they're doing sustainability investing in that they're very, very good at the finance bit, but they're actually not very good at the sustainability bit. We're based in London and San Francisco. We have about 90 people. I spend my day job investing with private equity fund.
Hi, everyone. Thank you for being here. My name is Erik Snyder, and I am the founder and CEO of the Drawdown Fund. The Drawdown Fund was actually inspired by Drawdown, which is the most comprehensive plan ever written to reverse global warming. And Paul Hawken, shortly after the publication of Drawdown in April of 2017, Paul and I spent some time together and decided that we needed to mobilize capital behind the solutions within Drawdown. And we went through all 100 solutions, which some are better suited for policy, some are better suited for culture change and movement, And some of the solutions in here are appropriate for market-based interventions, and our whole goal is scaling solutions to reverse global warming and contribute to it. So again, similar to generation and what David and Al knew early on about combining the sustainability with the capital markets financial expertise, they're actually an inspiration to us in what they've done. So very, very much appreciate that.
And since the title of this discussion is Investing for Drawdown, would you mind just taking a minute and giving us sort of a level set frame on what drawdown means in this context?
Yeah, so drawdown is the point at which we are no longer emitting more than we're taking down and sequestering into the earth. So Paul Hawken, who has been at the intersection of philanthropy and capitalism and entrepreneurship his entire career, had asked the question for many years of, if we acknowledge that climate change is occurring, like probably most of us in this room, what should we be doing to reverse it? So in 2014, he started a nonprofit called Project Drawdown, and he hired 75 research fellows from around the world to answer that question. They looked at all the peer-reviewed science and data, and then after a couple of years and aggregating that, reflected back to humanity what we already know through peer-reviewed science and data. And that publication is this book. It goes through and has really, really diverse solutions. So a couple ones just to call out. Solutions number 6 and 7, when combined, is the single greatest impact we can have, which is educating women in family planning. Because if we think about that overall, huge, huge impact. So super diverse solution sets, things that are better suited for policy, like bike infrastructure. So I would encourage all of you that what you care about has a link to climate in some way, shape, or form. And I think Drawdown is a beautiful framework for you to find how your passion areas might overlap and what you could get involved with.
Cool, thanks. So I don't want to moderate this, partly because I'm not sufficiently skilled to do so, but also because it's much more fun to have a conversation. But I don't really quite know how to spark the conversation. So I'll just sort of toss a grenade into the middle of this and say, 12 years, 1.5, 1, 2 degrees. What are you guys doing to maintain the optimism that we can get there with the tools that you have at your disposal? And I would love to start, Kristen, with you, because I know that you have a really concentrated public equity portfolio and have been thinking a lot about this for the last several years.
Sure. Well, thank you. So as you heard a little bit yesterday, Paul and I weren't together when we were thinking about these. We're kind of parallel play, like in the sandbox. And so he has 100 solutions and we have 6. And many of the 100 solutions fit into our 6 solution themes.
Did that surprise you?
No, not at all.
Okay.
No. We're basically simplifying what is needed for people and planet to thrive. We weren't specifically looking at how are we going to get the carbon back into the earth, but what is it going to mean? So we have healthcare solutions because we know that some of our worst diseases, particularly if we're thinking about our tropical diseases, as we think about that band of tropical diseases, that tropical disease band is growing with climate change. And so if we don't get a hold of those now, we're in trouble. Right? And so, of course, drawing down so that tropical disease stays in the tropical areas. But last year, Japan had their first 200 cases of yellow fever. They're not supposed to even have yellow fever there, and so what does that mean? And one of the places that we solve for our healthcare, both in innovation and access, is in public equities. So that's one of our themes. And particularly when it comes to women and some of our worst diseases there. So we're looking at HIV, Hep C, AIDS, and then also ovarian cancers and some of the breast cancers and things. And
did that emerge from sort of an investable analysis, or was that more values-driven, where you said, hey, healthcare is really important, access to healthcare is really important? We know that from a sort of a moral steering power issue. But did you come at that more from a sort of investable theme or more from a sort of a morality theme?
No, it's not actually investable or morals. It's what do people and planet need. So it's very illogical, actually. And you can have morals around your values, around, I would like people and planet to thrive. So I would say, yes, I want people and planet to thrive, but these are the 6 things that are needed for that to happen. And then from those 6 things, based on research, where can we address them in which asset class? And so not all of ours. Education is a really strong value. It's also a really strong theory of change for me. We haven't found a product or service in public equities that's actually our next best, ed tech play. And yet we look at education throughout every company, whether they're educating their own clients, their community, it could be just their pipeline, it could be their employees. Awesome company in South Africa, Sanlam, that's doing financial literacy. They're also doing age prevention through education, and they're also educating entrepreneurs as far as getting them through the banking system and loans. So at any rate, it really wasn't necessarily an investable thesis. One of our themes is eco and affordable housing. We know that that's necessary. Can we find that well in public equities? We have one company in England doing an amazing job. We haven't found anything in the US. So will we commit to those 6 themes? Yes. Can we find them all in the public equities? Not necessarily. And yet we build the diversified portfolio looking for all of those.
And does that sort of resonate with you guys in terms of sort of investable themes you want to focus in versus the ones where you can deploy capital? Are those gates around what you guys are doing as well or not?
Yeah, I mean, just from Generation's perspective, I mean, I think we have a framing which is around, we believe basically that sustainability is the biggest investment opportunity in history. That's really driven by the fact the economy's never been bigger, and the profoundness of change that's required has never been more acute. So we think these opportunities for sustainability kind of right across the economy, right across the world, right across all sectors. So what I think is really troubling is that the level of ambition that is woven into a lot of ESG strategies is not commensurate with the size of the challenge of this transition. And I think there's an emerging risk to a lot of investors who are claiming they're doing ESG and impact investing around this mismatch, which is effectively that they are not investing in solutions that truly draw down, get us to draw down. And what is interesting about that is that we spend a lot of our time with large institutional investors around the world, so large asset owners. Those are our clients. These are very, very large funds who have typically got, some of them have got 200 billion under management or something crazy, right? And they all ask the same question. They're all like, how do we put all of that to work towards sustainability? And it's very hard to answer that question because there is a lack of skill in the asset management industry around really understanding how to craft investment solutions for true sustainability. And that, I think, is going to start to present a bit of a backlash to the ESG movement in investing. You could even say that it could lead to some mis-selling representation from some asset managers. And what is really,
You mean greenwashing?
Greenwashing, and people are buying funds thinking they are sustainable, and so they are being misrepresented in marketing.
Yeah.
And that is a potential litigation bonanza. The other thing that's challenging is, of course, that the true impact of a lot of these solutions that are being invested in don't add up to enough. The context is changing continuously, and as we've heard, the climate challenge is getting so extreme now, and let alone all the other sustainability challenges, that a whole new level of understanding of what it takes to solve the climate crisis is required. And that level of know-how is just not prevalent in capital markets today. So we actually believe that this is an incredibly important piece of work, because it basically tells you that accelerated incrementalist solution investing is not enough, and that you need systemic level investing and systemic level change, and you actually need drawdown. So we're spending a lot of our time with our clients talking about exactly that and the limits of purely market-based solutions to dealing with many of these challenges. It is not simply a case of just throwing more money at these investment funds. That will not add up to enough. And so I would just appeal to you for something that was said on a previous panel is your money, every day you vote with your money. You do that through your consumer choices, but you absolutely do it even more through your investment choices. Every day, your dollars are perpetuating a view of the future that is either sustainable or not sustainable. So the best thing you can do walking out of this room today is to go and get your portfolios into sustainable portfolios. And once they are in those, make sure they are truly authentic in their impact. So very quickly, what we do at Generation is our theory of change has been at a reasonable scale. So, $23 billion is a lot of money, but it's not BlackRock, right? Show that you can perform through sustainability, which, touch wood, we've done okay so far. That gives us license to go into the boardrooms of the biggest asset managers, asset owners in the world, and explain to them why sustainability is a systemic risk to their portfolios. And that credibility is incredibly important when you're trying to persuade these organizations to actually move all their capital. So we do invest in all of the themes that have been mentioned. I want to echo the fact that there is absolutely no shortage of deal flow at all. Our biggest challenge at Generation is where to focus. And I think that that's just going to proliferate in terms of themes.
I'd like to just flag two anecdotes that I think will sort of illuminate the challenge that you just shared, and that is that one, where are the Generation copycats? I mean, you guys have been outperforming your index by a wide margin for now 15 years compounded. And we keep wondering, where are all the Generation copycats? Why are these other assets? And I know that when you guys launched, one of your theses was that by demonstrating superior financial performance, that other asset managers would follow behind. And broadly speaking, that hasn't happened. That's my first question. And my second question is, I was at a World Economic Forum event about a year ago, ended up sitting down with a woman who's on the board of directors at a large, well-known English reinsurance company. And we were talking about climate risk modeling. And she said, our underwriters have some of the most sophisticated climate risk models on the planet. I said, well, that's really cool. Then your asset managers must be using those same models. And she said, no. So you have this situation where an insurance company recognizes the material risks to insuring climate risk, but the asset managers who are investing all the assets that back up the insurance policies aren't doing it. So on that segue, talk to us a little bit about how you guys are thinking about that sort of next stage. And I would love for the two of you to chat a little bit about the private equity work that Generation is doing, recognizing that your history is really in the public equities.
Mm-hmm.
So first, I would just say you started this whole conversation off with a question around how do we stay positive, right? I think just everyone's presence in this room, sitting with two brilliant investors and you as an asset allocator, you guys are fighting the fight, and I think more and more people are. Yes, should we be concerned about greenwashing? Absolutely. And we each have a responsibility, whether that's with us, we have an impact carrier that ties our compensation to CO2 sequestered and emissions reduced. There are different ways that you can test someone's authenticity and the robustness of their climate models. But I have optimism because there are the conversations happening. Not everything's going to be perfect, but the market is moving. And I pose that question back to you. Is that what you're seeing as an allocator as well?
I toggle between optimism and despair, candidly. Optimism for that reason, but all you have to do is walk 5 blocks down the dark corridors of money in New York, and you realize that there's 70-story buildings on every side of you stuffed with people who just don't give a shit about this. Yeah. And that's it's crucifying to me because I'm sort of putting all of my professional credibility, whatever that is, on the line for this idea that the capital markets can be harnessed to first identify and fund and scale solutions to these great problems. And I mean, we're all doing that, right? It's not just me, it's all of us. And sometimes the conversations I have, they're disorienting. They're so depressing.
It's like going to Houston and trying to talk about renewable energy. Just don't go there.
But you have to put the money in.
Did you used to have an office in New York?
Did you really?
We did.
No, I mean, just ignore them and build the future. So
yeah.
There are some good people in Houston.
I'm sorry. I don't mean to throw
Ever the diplomat.
There are some good people on Wall Street, and the thing is, it can be very negative, and I've been there, and I'm still there. And you guys have seen me with my picture with the bull and the girl, and trying to take this on. I'm going to say that some of those people have just not connected the dots. There are those people that don't care, but so much in our society, particularly even with Drawdown, these scientists have the top 100 things, and divesting from the bad things and investing into the solutions is not listed. And Paul and I are in dialogue about that, and apparently his next book is going to be about that. So the power of our money hasn't been highlighted. In this conference, of course, Amy's doing an amazing job, getting that word out. And yet, it's almost elusive. We're not very connected to our dollars. Everything from our 401k. How many people have checked your 401k? What? You don't even know what's in there. None of us know what's in there because it's hidden behind ticker symbols. And these green funds, may or may not have fossil fuels, but they all have the big banks that are fueling the entire industry. And so it gets elusive and tricky.
Like BlackRock funding ADNOC?
I'm not talking
I wasn't
names
going to call
here.
it out, but
I'm
I just
not
couldn't, I
talking
couldn't
names
resist.
here.
We
I
have
mean,
to, you know what? We have
we
to
have
be
to
willing to
call it
have
out.
these hard conversations.
The
And I have a
incentive-
lot of respect for the work that BlackRock is doing. I really
Absolutely.
do. And that presentation that she gave was
Absolutely.
great. And there's
They're
like
leading
this,
the way.
There's
I
like
mean-
this intrinsic hypocrisy that is built into our existing financial system simply because the transition is really hard. And here BlackRock is co-funding with KKR, one of the largest pipeline deals in history, at the same time that they're, KKR at least, is announcing their impact fund. It's like, do we see that as inevitable tension inside of a large financial services company? Do we see it as
There's no
hypocrisy?
difference to an energy company or an oil and gas company launching a renewables business.
True.
Or a car company trying to launch an EV business.
So
It's
you're
the,
saying,
it's,
hey,
the, it's the challenge of
directionally.
it's the challenge of incumbency.
Yeah.
Right? BlackRock is an incumbent. T. Rowe Price is an incumbent. KKR is an incumbent. They are trying to transition to doing something, but they've been very successful doing something a particular way for a really long period of time. And that is really hard to do. So I just want to address your question about, because we on the private equity side of Generation, we try to invest in those companies that are 100% already part of the solution going forward. So there's no challenge of incumbent transition. And that applies to asset managers as well. So obviously, Generation was founded on the principle of integrated sustainability and on sustainability. That's kind of all we do. It's all we're ever going to do is sustainable investing. So why are there not more generations, right? So I think there's a few reasons for that. One was the financial crisis in 2008, basically meant that there was an enormous amount of regulatory cost and burden that got put on asset managers, especially institutional asset managers. So the back office expense of running an asset manager is really high. So what you need is a lot of operating capital to start a fund, right? So you can basically bear losses for a long period of time and pay for the back office, right? Now there are funds emerging that are funding new funds, right? So there are sustainable opportunities, asset managers and stuff like that. They're basically just kind of backing emerging GPs, which is really great news. And we're trying to help with some of that. But and then I honestly believe that there is a wave of new funds coming up that will be the asset managers of the future, the great asset managers of the future, like maybe this one, right? Or others, or maybe you, and like others that will just start to get scale because there's no ambiguity about what they stand for.
Which is
no
incredibly
ambiguity.
encouraging.
And they're pure play, sustainability-focused investors, and that's the future. So they don't have this incumbency transition challenge.
So Erik, how are you connecting the dots that Kristen mentioned when you're pitching for capital to a de novo fund with a relatively untested team, deep experience in operating, and you've got some experience in asset management as well, but like how are you connecting those dots to get to your first close?
Yeah, so it is to what Colin was saying, making sure that the sophistication on the investment side is there. So we spent, first 9 months working through every solution, figuring out the right type of intervention for each solution. Then we went through and said, okay, what does this team need to look like to be successful? Because we recognize, and the last thing we want to do is come to market and not be successful and do more damage than good. So we ended up figuring out, okay, what is this team? And it's really a purpose-built team with operators as well as people with 25 plus years of growth capital experience with incredible track records who have done it before and are proven. So it's that combination. And then the overlay, to Colin's point, around sustainability. And whether it's 6 solutions or for us, we identified 16 solutions from the 100 that we felt had amazing investment opportunities that currently aren't getting enough capital, where we see mega trends that they will outperform because of the sustainable revolution.
Yeah. Well, I think we're out of time. I wish I had a lot more time, as you can tell. I get sort of more and more excited as we go. But I want to thank the 3 of you. I'm sorry we didn't have time for questions. I had hoped to shoehorn a few in, but we just didn't get there. I think one thing we have demonstrated is there's an enormous amount of intellectual rigor that is now underpinning the entire investment approach to sustainability. So if any of you are hesitant to start deploying capital thinking that they're just activists masquerading as investors, I hope that this panel put that to rest. And I can say that for me, as a capital allocator, I've been doing this now for a long time, we do not have nearly enough capital to fill the investments that we want to fill. So this myth of absorptive capacity is simply that, it's a myth. So move your money.